What if your correlation assumptions are not good? And by the way, just to go back to that, I want to emphasize that in the 80s and 90s and early 2000s, CDO traders and RMBS traders got kind of anchored mentally to this kind of level of correlation. And they didn't think other levels of correlation mattered, but they just got in the habit of using these. That's anchoring, mental habit. Hi everybody, I'm Doug Costa. I'm a quant here at Susquehanna, currently working in the education department. My background is that in college I was a mathematics major. I went on from there to graduate school and I got a PhD in mathematics, specializing in commutative algebra and algebraic geometry, so in abstract algebra. In 1974 I finished my PhD and was lucky enough to be hired as a professor in the Department of Mathematics at the University of Virginia. And I stayed at the University of Virginia from 1974 to 1997. While I was at UVA in late 1993, I started consulting, doing some consulting work for Susquehanna. One thing led to another, and in 1997 I came here full-time as the head of the Quantitative Research Group. I led that group from 1997 until 2015, when I transitioned into the role I have now in the education department. As part of the education department, I teach classes to our summer interns, and one of them is a series of classes on the financial crisis of 2008-2009. And my goal today is to show you a little piece of that lecture, involving a mathematical phenomenon that was very poorly understood by a lot of people back in 2008 and the years prior to that, that led to massive losses for several investment banks and hedge funds. And when I say massive losses, I mean losses on the order of billions of dollars, multiple billions of dollars. Okay, so to understand this phenomenon, we first have to go through background material on some of the financial structures that were involved in the crisis in 2008-2009. So I'm going to start by talking about bonds. This is the most basic structure that we need to consider. As a mathematician, I like to think of a bond kind of abstractly as just a series of cash flows. So I'm going to call those C1, C2, up to C subscript capital N. And the cash flows are paid at set times. And the times in increasing order are times T1, T2. These are times in the future up to T subscript capital N. So CI is paid at TI. That's the cash that's paid at TI. In a minute, we'll talk about treasury bonds and corporate bonds in particular, but just continuing in this kind of abstracted version, notice that if we have an interest rate curve, R of T, so this is the interest rate applicable to future time T, to a cash flow paid at future time T, and I'm going to use continuously compounded rates to make the math easy, so I can use exponentials for this. Given the interest rate curve, then a simple way to express the value of the bond today, the bond price, is just to sum up the discounted cash flows. So I take each cash flow, multiply by e to the minus r of ti times ti, that's the discount factor, and that's the present value of the cash flows. So that's just an explanation of a simple abstracted version of a bond. Now we're going to talk about treasury bonds. U.S. treasury bonds and corporate bonds are standardized. So U.S. treasury bonds come in a range of maturities: 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30 year. And they're standardized to pay a fixed cash flow, and their payment schedule is semi-annual. So every 6 months, you get a fixed payment up until the last cash flow. So I've illustrated that here by calling that cash flow the semi-annual cash flow C. It's a constant, so C1 through Cn minus 1 are all equal to C. But the last payment is going to be the last coupon, these are called coupon payments, plus the face value of the bond. So for example, if you had a 5% coupon bond, that's the way you name these things, that means you're getting 5% of the face value in interest every year. Semi-annually means if the face value is 100, 5% would be $5 per year, but since they're split into two payments, the semi-annual coupons would be $2.50 each. So that's the way Treasury bonds are structured. An important point about Treasury bonds is that they're basically risk-free. There's no default risk. We assume that the US government is not going to default. Okay, in contrast to that, we get to corporate bonds. So corporations need capital, and they have two main methods for raising capital. One is issuing debt in the form of bonds. The other way is to sell stock, so that's equity. So a corporate balance sheet consists of liabilities, which is debt and other things like accounts payable, and equities on one side, and they use that capital to buy assets. So you have another column of assets that balance out the liabilities and the equity. Now, corporations are risky. They're engaged in speculative businesses, sometimes less speculative, sometimes more speculative. So some corporations are more risky than others. So corporate bond pricing is a little bit trickier than risk-free US Treasury bond pricing. So here is a very ultra-simplified version of it. So we have the same structure of coupons paid at fixed times, but for a corporate bond, you can take the discounted value, and here I'm thinking of that as the risk-free interest rate, say the US Treasury rate curve. But you have to realize that there's a chance that the corporation may default on its bond payments. And that default process can be modeled as a Poisson process. So there's some kind of hazard rate indicating the intensity of the default probability. And the probability that there's no default by the time this coupon is due can be represented as e to the minus lambda ti, where lambda is that hazard rate. So that means the expected payment is going to be the discounted cash flow times the probability that you actually get it. So this is going to look something like the sum of the coupons times e to a factor that's bigger than the risk-free rate. Now, it's really a lot more complicated than that because in reality, when a corporation defaults on a bond, or let's say in the worst case scenario, the corporation goes bankrupt, what bankruptcy means is that the company is insolvent, which means that the liabilities exceed the value of the company's assets. So if you think of the balance sheet, liabilities and equity on this side, assets on this side, when the liabilities exceed the assets of the company, it cannot pay its liabilities. The stock price goes to zero. The equity is worthless. But the assets aren't totally worthless. So the bondholders then go to court, and a judge decides how to divide up the remaining assets and give them to the bondholders. So the bondholders may not get nothing. And here I've represented this as if, well, you get all or nothing. So in reality, we would have to put in there some recovery rate. You might get 50 cents on the dollar. So it's a little more complicated, but still, you wind up with a corporate interest rate curve that's a risky interest rate curve. And notice that this is going to be different from one corporation to another. Let me just remark that the higher this rate is, the lower the cost of the bond. And you can think of that in reverse. How do you make more money or get a higher rate of return or a higher rate of interest on a bond with fixed coupons? Well, you just pay less for it. So by paying less, de facto, you're getting a higher rate of interest. Okay, so how do investors know what a reasonable corporate interest rate is? Well, this leads us to bond rating agencies. So this is an important part of the story. During the financial crisis, the bond rating agencies played a key role by giving ratings to things. So the main ratings agencies are S&P, Moody's, and Fitch. And here I've illustrated the ratings that are used by S&P, Standard & Poor's. They have these categories of bonds. They call them AAA, that's excellent, that's their top rating. And then they have the AA's, which range from AA plus AA down to AA minus. And then there are the A's, A plus, AA minus, triple B plus, triple B minus. And then they go lower than that, BB, B, and the C's. And what I'm highlighting here is that in this region, all the bonds that are rated from AAA down to triple B are considered investment grade. And that's signified by IG. So we use IG to stand for investment grade. The bonds that are below investment grade, well, back in the 80s, we used to call them junk bonds. But that's not considered polite anymore. So now we say, as opposed to investment grade, these are high yield because they have a high rate of return. So HY is the current polite term for junk bonds. How accurate are these ratings? Well, the ratings agencies try to give ratings that reflect true probabilities of default. And they've done studies, and other analysts have done studies, to see what the 1 year, 2 year, 3 year, 5 year probability of default is based on a bond's rating, or what the statistical empirical results were. So there was a study of actual bond defaults during a 1 year period, and it was done from 2008, data from 2008 to 2018, and that showed that AAA bonds had 0 defaults, AA plus 0 defaults. AA bonds had 0.02% failure. So notice that's not 2%, that's 0.02%. That's like 2 basis points. It's 0.02% is the probability of default in 1 year for a AA bond. So that's pretty good. And they keep going down. I didn't write them all down here. The triple B minus, which is the lowest investment grade, had an actual realized default rate of 0.28%. So still around 0.25%, not even 1%. As soon as you get into high yield, BB plus, it's 0.68%, jumped up quite a bit, almost 1%. And when you get down to B minus, it's 10%, and the C's were 23% overall. So that's a pretty high rate of default within 1 year. Now we can proceed to talk a little bit about the corporate bond market. So back in the 80s, the market was really booming. Investment bank trading desks, fixed income trading desks were making lots of money from commissions and trading 2 ways in corporate bonds. And they were looking to increase their profits by increasing the volume of trading that they did. Among their biggest customers were insurance companies. And what is an insurance company? An insurance company is a company whose business is to collect cash. They just suck cash in the forms of insurance premiums constantly from customers who are buying insurance. And this could be life insurance, homeowners insurance, auto insurance, and annuities. They sell annuities. So they get monthly premiums typically from customers, and they're just collecting all this cash. Now, because they are insuring people's lives and trying to help people take care of their families in the event of their passing, insurance companies, especially life and annuity companies, are pretty rigorously regulated. And the regulators require that if they invest that cash, so insurance companies are trying to invest cash to pay predictable payments they have to make in the future. So for example, the number of people in any age cohort who are going to die in the next year is random, but it's very predictable. Very predictable. So insurance companies that sell life insurance policies know when they're going to, roughly speaking, when they're going to have to pay and how much they're going to have to pay. So they try to buy bonds that match up with the schedule that they expect to have to pay out on. And because they're insuring people's lives and their families' well-being, they are required to use investment-grade bonds, often A and up. So insurance companies are always looking for more high-rated AAA down to A investment-grade bonds that they can invest in. Okay, so this poses a problem for the corporate bond market. There's just a limit to how many of these things are investment grade. And another problem that the corporate bond market faced in those days is that they were accumulating lots of high yield bonds. They were trying to issue bonds on behalf of more risky companies that had lower credit ratings. But the question was, how can you market those? How can you market junk bonds? Doesn't even sound good, or high yield bonds, which sounds a little better. So we're going to go into that in a minute, but before we do, I have to mention another kind of bond that played a crucial role in the financial crisis, and that's mortgages, home mortgages, commercial mortgages too, but the real crux of the matter was home mortgages. So what is a mortgage? A mortgage is a different kind of bond from the treasury and corporate bonds we've described. It's a self-amortizing bond. What that means is, in the typical structure where you make monthly payments with a 30-year maturity, and these are fixed monthly payments, each payment includes some of the principal that you owe. So you put in a down payment, maybe 20%, maybe 15%, you owe the remaining principal of 80%. The payments here are designed so that every month you pay a little bit of the principal. And once in the first month you pay part of the principal, then the next month your principal is lower. You still have the same fixed rate of interest that you pay on your mortgage, say 7%, but now it's 7% of a lesser amount, so you pay less interest, so that fixed monthly payment goes more toward the principal, and each month the amount of principal you're paying off increases, and the monthly payment amount is designed so that at the end of 30 years, at that very last payment, you finally pay off the principal exactly. So there's no balloon payment at the end. In a corporate bond or a treasury bond, the entire face value is paid in the last payment. You can think of that as a balloon payment, but most ordinary people who buy a home can't afford to make a big, huge payment at the end. So that's what a self-amortizing bond means. It's a mortgage, basically. Fixed income trading desks at investment banks have this problem. We have these large customers. They prefer investment-grade bonds, preferably A-rated bonds. We have an accumulation of companies that are issuing bonds that are high yield, junk rated. What can we do to increase the business there? So they invented CDOs, collateralized debt obligations. In the 1980s, these were invented at Drexel Burnham Lambert, which is an investment bank which no longer exists. So we need to understand CDOs, collateralized debt obligations. Okay, what is the idea? Well, the idea is a brilliant idea. The idea is to imitate the diversification benefits of an equity index. So let's recall for a second, what are the diversification benefits of an equity index like the S&P 500 index or the Russell 2000 or 1000? If you invest in the S&P 500 index, you have a weighted collection of 500 large cap stocks. The return on the index will turn out to be kind of the average of the returns. It's a weighted average, so some of the returns have a 5% weighting, some of them have a 1% weighting, et cetera. But roughly speaking, it's the average of the returns. what is the riskiness of a stock? Well, you can think of it as the variability in those returns. How much do they fluctuate? We call that in math the variance or the standard deviation. I'm going to use the word variance. So the variance of the returns is kind of a risk measure of the stock. But if you take an average of 500 and they're roughly independent of one another, meaning their correlations are low. If their correlations were 0, then the variance of the weighted sum of the returns would be the weighted sum of the variances. Well, the math of that indicates that the variance of the index is going to be on average 1 over, for the S&P 500, 1 over 500 times the average variance, which substantially reduces the risk. So the index is a lot less risky. So that was the idea. Let's imitate that with corporate bonds, with risky corporate bonds. So in a CDO, what you do, if you're Drexel Burnham Lambert or a big investment bank, is you create a special purpose investment vehicle. This is a little company. It's a bespoke company whose purpose is only this. So it's a subsidiary of your bank. The SPIV then goes out and buys 10 million, I'm giving you an example, they're not all exactly constructed this way, but here's an example. They'll say buy $10 million of face value of corporate bonds from 100 different corporations. Okay, now the idea is to achieve some diversification by choosing these corporations, these corporate bonds, from corporations from different sectors. So companies from, say, the tech industry, from the financial industry, from energy, utility companies, maybe agricultural companies. So you get a wide diversification of stocks, and hopefully that reduces the correlation of their behavior. So the default probabilities are more or less uncorrelated. Okay, then you pool all the coupon payments coming from these 100 corporate bonds. So the coupon payments are flowing in, and what we're going to do is slice and dice them. This is called tranching. The word tranche is a French word that just literally means slice. Like a slice of pizza in French would be a tranche. Okay, and here's what it looks like. Here's the SPIV. 100 bonds, 10 million face value each, 1 billion of face value total. Coupons are pouring in. For Drexel Burnham Lambert and others, the ideal was to use high yield. So you take 100 high yield or junk bonds and put them in there. And then what you do is, as the coupons come in, you sell to people the right to collect coupons, but you do it in what's called a waterfall structure. So this picture is supposed to show you, think of the coupons as water flowing through pipes. The first bucket is the first tranche. So coupons come in. The first coupons that come in every quarter, and typically they'll pay out quarterly or semi-annually. The people who pay to own part of the first tranche will get those first payments. When the bucket fills up, in other words, as the coupons come in, once there are enough coupons to fill this bucket, the rest of them go into the next bucket, down the waterfall. I'm going to call this the super senior tranche, tranche 2. I'm going to call senior tranche 1. And the next payments come in. So notice that if you buy part of the super senior tranche, the coupons you get are not necessarily coming from a single bond. They're coming from all 100 bonds, and you're just getting the first ones that come in. Likewise, you go down the waterfall and you may have many, many tranches, many senior tranches, you get junior tranches, and then at the bottom of the waterfall you have the next to the last tranche, which is called the mezzanine tranche, and the very bottom one called the equity tranche. And maybe 50% of all the payments go into the equity tranche. So what is the risk here? Well, the risk is if some companies default on their bond payments, then some of the coupons don't get paid. So who is hurt by that first? Let's say the first default. Well, the only people in this structure who are hurt are people who own part of the equity tranche, because the first missed payments are going to be coupons or water that doesn't flow into this bucket. As there are more defaults, the next tranche to be affected would be the mezzanine tranche. But notice you have to back way up the waterfall. These guys are going to hardly be affected. The probability of them being affected is pretty low, which means when you're building a CDO, like Drexel Burnham Lambert, for example, you then go to the ratings agency and you say S&P 500, this should be AAA, and S&P 500 agrees with you because it's very safe. It's hardly any risk at all. So suddenly you have AAA, and notice buying a tranche means getting coupons. That's just another kind of bond. Suddenly you've manufactured AAA products out of 100 junk bonds. It's magic. This is just absolutely brilliant. It is a great idea, fundamentally, and it works pretty well. So you get ratings for all of these tranches, and because of this waterfall structure, you get many A-rated tranches, and even the mezzanine might be BBB, which is still investment grade. It's possible. Usually the equity tranche is not investment grade. So you wind up with this last bucket and possibly the last two buckets that have lower ratings. Cultural phenomenon or note. Back in the day, people used to refer to this part as toxic waste, and you can see why. Okay, so this is a brilliant way of manufacturing more AAA products that you can sell to insurance companies out of high yield or junk bonds. Now, here's the toxic waste. What do you do with that? Now you have another problem. Okay, now we don't have junk bonds anymore because we've transmogrified them into tranches of CDOs. How can I possibly get rid of this stuff? Okay, well, set up another SPIV. Collect 100 high-yield tranches of CDOs. In other words, once there are enough CDOs in existence, you can take equity and mezzanine tranches of them, put them in a SPIV, make a waterfall out of those, and create new AAA products. And that's called a CDO squared because it's a CDO of CDO tranches. By the way, mathematically speaking, this creates path dependence, which is a very interesting problem, and the complexity of solving for the price of a CDO squared is much higher than for an ordinary CDO. As I say to my class, most people, when they hear about this for the first time, are just kind of amazed and think, wow, did people really do this stuff? The answer is yes, they did. One problem in those days was that very little of it was transparent. There was very little regulation of it. Now, people still do it, but it's much more heavily regulated and there's a lot more transparency. Okay, well, this is such a great technology that it didn't stop there. So people went on, investment bankers and others went on to create CDOs of mortgages. Actually, Fannie Mae and Freddie Mac were doing this even before. That's probably where the idea of CDOs came from. So you can have CDOs consisting of mortgages, because a mortgage is also a kind of bond, and those are also things that can be rated by ratings agencies. So CMBS were CDOs of commercial mortgages. The C stands for commercial. R stands for residential, home mortgages. So this would be a CDO of hundreds of commercial mortgages. This would be a CDO of thousands of home mortgages. But now one question comes up with mortgage-backed securities. How do you achieve diversification? Well, the thinking, and this is fairly justifiable thinking, was, well, we can do it geographically. So instead of getting thousands of mortgages just from the Philadelphia area, which is where we're located, spread them out over the country. Spread them out so that you have hundreds of mortgages from New England, mortgages from the Pacific Northwest, mortgages from California, mortgages from Florida, mortgages from Texas, mortgages from the upper Midwest, from the Southeast. The thinking was, well, What we're worried about in a CDO is defaults affecting those tranches. And we want the defaults to be uncorrelated so that the defaults really just affect the equity tranche and the mezzanine tranche. Well, if business is bad in New England, let's say the lobster harvest is poor and some people default on their mortgages, that has nothing to do with California, Texas, Florida, or the Midwest. They're not going to be affected. So there's little correlation among different geographic areas because their economies are not that closely linked. Once you've constructed CDOs of mortgages, then you can construct CDOs of residential mortgage-backed security tranches, right? So now you again have this problem. What about the equity and mezzanine tranches of a residential mortgage-backed security? Well, how do you make those saleable or investable? You can make a CDO of those bottom tranches. Notice, since an RMBS really is a CDO of RMBS is really a CDO squared, but people didn't refer to them that way. They just called these CDOs also. So that's a whole technology for manufacturing investment-grade products out of high yield or non-investment grade products. In the 1990s, one trading desk at JP Morgan, that's supposed to be a J there, sorry, came up with a great idea. A young woman named Blythe Masters, who was a trader on their fixed income desk, came up with a wonderful idea, which was to imitate municipal bond insurance. The idea was to imitate insurance on municipal bonds, which is basically a kind of insurance, and imitate that for corporate bonds. So she was thinking, how can we increase our volume of trading in high yield corporate bonds? Well, one way to do it is to create an insurance product that guarantees the bondholder that they'll be compensated in case of default. Okay, so these products were called credit default swaps. Credit default swaps are just an insurance policy on a particular corporate bond. So an insurance contract on corporate bond. So the CDS buyer, that is a person who's buying insurance. They're buying protection. So they're buying protection on a particular bond. The buyer pays a quarterly premium. That's the insurance premium. But it's also a cash flow, so you can think of that as creating a bond-like thing. If default occurs during the term of the contract, and CDS contracts, by the way, nominally usually had a 5-year term. They could be issued with 3 or 4 or 5-year terms. 5 was the typical maturity of a CDS contract, a credit default swap. But they can go out to 7 or 8 years as well. Now, if during the term default occurs on that bond, then the seller pays the loss to the buyer. Whatever the buyer loses is paid by the seller, and the contract terminates. There are no more premium. Initially, the way these were structured was that the protection buyer had to own the bond. He had to show up with the bond and say, okay, here's the bond, I own this, I want to have insurance on the bond I own, just like a homeowner owns the home. Now, if you do that, notice that that limits the number of possible CDS contracts to the number of extant bonds. And for traders, more volume means more profitability, so they wanted to up that. So eventually, they started writing credit default swap contracts in which the protection buyer did not have to own the bond. They just simply named a bond and said, I want insurance on that bond. So this now means that there could be thousands of CDS contracts, thousands of insurance policies on the exact same bond. And because these were new inventions in the 1990s, they were unregulated. They went under the radar, and because they're OTC, that means they're over-the-counter products. They're contracts between two counterparties, two individuals. One of the individuals might be the investment bank. Because they're private contracts, they don't have to be reported to anyone, not the government, not the public. Nowadays they do. After the crisis, that was one of the reforms, but in those days they weren't reported. Also notice, because it's a contract between two counterparties, it means that there's counterparty risk. One of the counterparties themselves could default on its obligations under the credit default swap contract. Another thing I need to add here is that if these are corporate bonds, the protection buyer is then called short, because the protection buyer under the CDS contract wins, meaning gets a payment. So the protection buyer is just paying premia, but they get something, they get a payment if the bond defaults. So they're really short the bond, they're short that corporation. They're hoping, if you're just a pure CDS buyer and you don't own the bond, you're making a bet that the bond is going to fail. So you're short that bond, short that corporation. If you're the protection seller, you want the corporation to succeed and not default. So you're kind of long the corporation or long that bond. So if you read the book, The Big Short, this is the terminology they're referring to. The people who were short were the people betting on failure. Okay, so once this concept of the credit default swap came into existence for corporate bonds, and then not having to own the corporate bond, it got generalized to include credit default swaps on CDO tranches and credit default swaps on residential mortgage-backed security tranches. So now you've got a proliferation of credit default swap contracts. And of course, for an insurance company, for example, buying a high-yield bond plus a credit default swap on that bond makes it a AAA product because you're guaranteed not to lose. Now we come to mortgage loan originators. So these are local retail banks, savings and loans, commercial banks that are regional banks that issue mortgages to homeowners. They are participants in this because to construct residential mortgage-backed securities, those CDOs of mortgages, you need lots of mortgages. So you go to these mortgage originators and you say, sell me your mortgages. What this meant for loan originators was they figured out, oh, I can issue a mortgage to someone and then sell it out to an investment bank, and I don't have any of the risk. So I don't really care how risky the mortgage is. I can just generate more and more mortgages by loosening my credit standards. So from 2000 to 2007, we had lots of mortgages issued with low, what are called teaser rates. This word is supposed to be teaser. So this means in the first 2 years of the mortgage, the interest rate is very low, sometimes as low as 1%. And eventually they started issuing bonds with teaser rates of 0%. So that the monthly payments for the first two or 3 years would be extremely low. They also loosened lending terms to the point where you could have a 0% down payment, you could have a 0% teaser rate, you could have an interest-only mortgage where every month you're paying the interest and none of the principal. They also started lowering their vetting standards so that they issued what were then called ninja loans. That means no verifiable income, no job, no assets. In other words, someone who wanted to buy a home could show up with a driver's license and a W-2 form and then walk out with a $750,000 loan without having proven any source of income, any job, or any assets. So those were called ninja. It should be ninja, but they said ninja. In addition, things got so extreme that some mortgages were issued with negative amortization. Remember, we talked about self-amortizing. In these mortgages, the payments would be so low, the monthly payments would be so low, that you weren't even paying all the interest. And the amount of interest that you didn't pay each month would be added to the principal. So instead of your principal going down, your principal was going up. One of the effects of this was that it became easy to buy a house because the mortgage originators were relaxing these lending standards, selling the mortgages to the people who made RMBSs and CDOs on RMBSs and not having any risk. So people who would ordinarily not be able to buy a home were able to buy homes, and it was actually in their interest because very often the monthly payments on these very loosely constructed mortgages were lower than it would have cost to rent an apartment. So they would think, okay, might as well buy a house. This created huge demand for houses. Prices went up, and they went up in a straight line pretty continuously from 2000 to 2007. In 2007, because these teaser rates ended, a lot of these homeowners who bought homes with mortgages like ninja mortgages on the basis that their monthly payment was lower than rent suddenly discovered that the interest rate on their mortgages jumped from 0 to 9%, the monthly payments jumped, and suddenly it wasn't really worth it. So they started selling houses. Prices started falling in 2007, and that made things doubly bad because now you couldn't even argue that it was a good investment that you could sell because prices were always going up. During this period when prices were rising constantly, some of these borrowers were out buying 2 or 3 or 4 houses thinking, oh, I'll hold the house for a year and flip it because prices just go up and up and up. Okay, so once prices started to fall, defaults started to happen. And by the way, these borrowers who borrowed on these very loose lending terms are called subprime borrowers, and those mortgages are called subprime mortgages. Well, in 2004 and 5, in that time period, there were some very perspicacious investors. These were investors with small amounts of money to invest, little hedge funds run by people who were very, very focused on details. And they started sniffing around, and they noticed that there were a lot of residential mortgage-backed securities, which were supposed to be diversified, but which had a lot of subprime mortgages in them. A couple of these RMBSs were like 60% subprime mortgages. And they started investigating those mortgages and realized, you know what? If things go bad, all those people are going to behave the same way. Even though they're geographically distributed, the subprime mortgage holder, when things go bad, is going to default because it's going to be cheaper to just go back to an apartment. They're just going to default on the mortgage and then mail the keys to the bank. At the same time, so there were these few people who saw that, but most people didn't, including most hedge funds, most investment banks, who were still pricing CDOs and RMBSs in such a way that they rated the tranches of even subprime mortgage-backed securities very highly. So CDS protection, remember, this is an insurance contract. What are the premia to insure tranches of a subprime RMBS? Well, they're still very low, 15 to 25 basis points. A basis point is 1/100%. This is very cheap. So the insurance on these things was incredibly cheap, and some of these guys said, okay, the senior tranches have very cheap insurance, let's buy that insurance because we see that subprime mortgage holders are going to default en masse when the time comes. They'll be very correlated. Okay, so some of the fixed income trading desks at investment banks saw these guys doing this and they thought, oh, you know what? There is some risk here. And they said, you know, the equity and mezzanine tranches, these sort of more toxic tranches, are bad. And maybe we could make some money by buying some protection on those. So buying protection on those means going short these equity and mezzanine tranches. So that was a good trading idea for some of these investment bank trading desks, they thought. The problem with that is because these are the bad tranches, the CDS protection on those is expensive. So you're trying to insure something that is more likely to default, so you have to pay a higher premium. Well, they did that, and some of the trading desks were paying premia, and their bosses were saying, why are you losing all this money? Why is this money flowing out of the business? And they'd say, well, because we think we bought insurance and we think these are going to go bad someday, but it's been a year or two, and so their bosses are getting a little angry. So they say, they're traders, and they're thinking, let's hedge. How do you hedge this? So they say, let's hedge by, instead of buying protection, selling protection on the senior tranches because they're safer. So let's go long the senior tranches. Well, one problem with that is that when you sell protection on senior tranches, that's cheap, and you're not getting nearly as much money as you're spending to buy the CDS protection on the equity and mezzanine tranches. So to compensate, you have to go long more and more to get the same payments coming in that you're paying out. So sometimes they would be 4, 5, 10 times as long as they were short. This turned out to be a fateful decision, and this is where the losses are going to come from. So we're going to try to get to the bottom of that. Okay, in order to get to the bottom of it, we have to understand how to price CDOs. So the standard pricing model for CDOs, starting in the 80s and running through the 90s and the 2000s, was a model called, so we're doing the math here, called the Gaussian copula model. Let me explain these words. Gaussian just means normal distribution. Copula means a multivariate joint distribution. And we're going to build a model based on that. And the idea is, how do you model defaults of 100 companies in a corporate bond CDO? Well, what you do is you represent the solvency of a company by a normal random variable xi. This is actually a stochastic process, basically a Brownian motion. The idea being, think of the balance sheet, liabilities and equity on this side, assets on this side. Default is going to occur when the assets are less than the liabilities. So you take the log of the assets and assume that follows a roughly normal process. This is called the Merton model after Robert Merton. And you just say, okay, default is going to occur when the log of the assets, which I can think of as a Brownian motion, is less than some threshold, which would be the log of the liabilities. But you can just abstract it and say, I just take some standard Brownian motions and I can pick numbers, Ci, that I can calibrate to, say, the 5-year default probability of this particular corporate bond, so that the probability that Xi is less than Ci within 5 years is the correct probability according to the bond ratings. Then you set up a Monte Carlo simulation of the joint 100 processes, and then what you're going to do is just monitor that. You're going to run, say, 40,000 simulation paths, and in each one, you just count how many things fall into the default category, and then price the cash flows that come into the CDO that way. And then you average them, and that tells you the correct price of the CDO. Here's a problem, though, the mathematical problem, which is, in order to run a joint distribution process for 100 normal random variables, you need a correlation matrix. A correlation matrix for 100 variables is really hard to get, statistically speaking, to estimate properly. Also, mathematicians all know that the correlation matrix has to be positive definite in order to run the Monte Carlo, in order for the thing to be mathematically correct and consistent. So investment bankers who were constructing CDOs went to their quants and say, how do you model this? And they said, well, you could do this, but we need a correlation matrix, and that's a problem. The quants came up with a very clever approach to this, and that is called the single factor copula model. The idea was, let's make the correlation matrix look like this. Ones down the diagonal, which are the correlations of each variable with itself. They have to be ones. But every other off-diagonal entry is the same, equal to rho. So we're going to postulate that the pairwise correlations of xi and xj are all equal to rho, a constant. Now that's a gross oversimplification, and you couldn't hope for this to really work. But traders said, well, okay, that's good enough because we can think of this like implied volatilities for options. They said, okay, let's do this. Let's make a graph here of credit quality versus what I call the implied correlation, rho implied. And what they mean by this is the following. I'll look at a particular CDO, and I'll look at the equity tranche, the mezzanine tranche, then all the junior tranches, the senior tranches, and the super senior tranche. And I'll look at what the market price is. Where is that tranche trading? And then I will run the copula model, the Gaussian copula model, with a single correlation and back out the rho that gives me the market price. And what they found typically was a picture like this. For the equity tranche, the correlations would be about 40%, 0.4. For the mezzanine, somewhere around 3, and so on. And you get this downward sloping correlation smile, this curve they called the correlation smile. And what they found in the 80s was that for a well-diversified CDO of corporate bonds, this smile was pretty constant. And so traders learned to trade around this. They said, okay, my mental model of the CDO world is we have this correlation smile, and that should basically set the correct prices for all the tranches. Now, that works insofar as your diversification assumptions are good. So here we're coming down to the nub of things. What if your correlation assumptions are not good? And by the way, just to go back to that, I want to emphasize that in the 80s and 90s and early 2000s, CDO traders and RMBS traders got kind of anchored mentally to this kind of level of correlation. And they didn't think other levels of correlation mattered, but they just got in the habit of using these. That's anchoring, mental habit. But what if they were actually higher? Well, obviously, if the correlations of defaults are higher, then the lower tranches and even some of the higher tranches of a CDO are going to suffer more. Okay, so what I'm going to show you is this phenomenon. It turns out that the correct prices to use for subprime residential mortgage-backed securities, the correct correlations to use to price them, were closer to 80 to 85 or 90%, not 0.4 or 0.3 or 0.2 or 0.1. That's substantially higher. So the phenomenon that people didn't really understand until that point, although some quants did, is that if correlations are much higher than you thought, the effect on the senior tranches is much more devastating than the effect on the equity tranches, the low tranches and the mezzanine tranches. And I'm going to try to get across to you how that works by doing a very simple CDO. Here's a CDO that has only 2 bonds in it. And there are only 2 tranches. The senior tranche gets the first payments of coupons that come in. The equity tranche gets whatever's left over. Now let's suppose that both bonds have probability P to default. We're going to make a chart here of the probability of a loss to each tranche. So here's the senior tranche and here's the equity tranche. If correlations are 0, then defaults are independent, so the probability, so notice the senior tranche will only be hurt if there are 2 defaults, both default. That's the probability of that is P squared. For the equity tranche, that's hurt only if there's 1 or 2 defaults, which is the probability opposite event of no defaults. So that's 1 minus P squared, which is 2P minus P squared. If probability of default is 5%, 0.05, this is very tiny, 0.0025, 25 basis points. But this is 2 times 0.05, or 10%, minus a little bit, actually 9.75%. That's pretty high. But what if you're wrong? What if correlations are really 1? What if I'm going to use 1 as a proxy for high? Well, if correlations are 1, it means either they both default or they don't both default, which means that the probability of a loss for both tranches is the same, P. Notice what happened. The probability of loss for the senior tranche went from almost nothing to 5%. It went up by an order of magnitude or more. What happened to the equity tranche? Amazing. It went from 10% down to 5%. It got better. So all of these trading desks who decided to go short the equity tranche as an investment, a bet against subprime mortgages, and hedge by being long senior, were short the thing that was going to improve and long the thing that was going to get worse. And this cost them, and notice also they were way much longer the seniors than they were short the equities. So they wound up losing like, 13 billion on this and only gaining 4 billion on this. This is one famous case, losing 9 billion altogether. Okay, so that's the story. I hope that was comprehensible, and I hope you learned something and it was interesting. It's the kind of thing that we think about here at Susquehanna all the time, really fascinating stuff. Again, I'm Doug Costa in the education department. We're known for our education department. We teach people a lot of things, and I hope to see you here one day and hope to be able to teach you more things. Thank you.